Okay, so thanks to everyone that's joining. I'm going to give it just a couple minutes here to let some more people fill in as we get to the top of the hour. I have a good amount of questions that I've collected via DMs and comments and just people responding to my newsletter and other things like that. So I have some good questions that I think are relevant and top of mind for, I think, some of the people in the audience actually. And also, you can go to the page that I think you're all on listening to this on LinkedIn, and there's a comment section. And if you have a question that's top of mind either now or during this conversation, comment on this page or comment below, and I'd be happy to answer it for you. I'll be checking that periodically as well, and I can get to some of that. So we'll give it a little bit longer here. We'll let a couple more people fill in, and then we will start on some of these questions. And I encourage everyone to like and also share this so we get more exposure and we get more people in here and participating, asking questions. Okay, so we're gonna get started. So again, I appreciate everyone joining me here. I'm Patrick Camuso. I'm the Managing Director of Camuso CPA, and I'm going to be hosting this today. As I was saying, I have a good list of questions that I've collected from many of you in the audience before this event via DMs, comments on some of the posts I've made, responses to my newsletter to Digital Asset Digest, and other forms of communication. So I'm going to start with some of these questions, but comment right on this event page here on LinkedIn if you have any questions. I'm going to periodically refresh this and check the comment section. I have it on most recent, and I'm happy to respond to your questions in live time. So the first question that I have is related to Form 8300 and the 650I reporting requirements. So and basically the question is to just explain the reporting requirements, who is required to report, and when are you required to report. And this is obviously something that you have probably seen in headlines over the past couple weeks. It's been sort of a big topic, and I know that I've been getting a lot of questions about it, and it's no surprise that it's top of mind here as well for everybody. Now, the IRS just this week did release announcement 2024-4, which is giving some transitional guidance related to this, the reporting requirements. And basically the gist of this notice is that the IRS is going to clarify further via future regulations the reporting requirements and how we're going to report digital assets on Form 8300. And this is indicating that currently right now that reporting is not required. So again, I encourage everyone to obviously speak directly with their CPA or tax lawyer regarding this. But that is the latest update regarding Notice 2024-04. Now, in general, what I'm recommending in most cases is that clients, if they're going to meet the reporting standards for this, to still make sure that they're collecting the relevant information from anyone that they may need to report on in terms of if they're receiving over 10K in a transaction. So when and if you do have to report this information, you're going to be in a position to report it. So that is basically the gist of Form 8300. If you have any follow-up questions on that. So someone said that they have a question, basically, what am I talking about? So basically, just, I guess, to back up a little bit with Form 8300 and 650I, it's basically going to require anyone that is rising to the level of a trader or business. So this can be someone that has an LLC, has a corporation, has a partnership, or it could even be an individual whose activities rise to the level of a trader or business. If you meet this definition of a trader or business and you receive 10K or over in value in terms of a crypto that you receive as a payment, you'll have to report information on Form 8300 to the IRS. What will be included in this is basically KYC information on regarding the company or the person that paid you the crypto in the course of your trader business. So this reporting requirement is not going to lead to a new tax that anybody has to pay, but it is going to lead to this informational reporting requirement. And if it goes overlooked, there can be significant consequences in the form of tax penalties. So that is a high level overview of Form 8300 to answer your question. And I think that question was sent to me in a message. I just lost the message now, but I do appreciate that question. And continue to comment with more, or you can shoot me a DM as well, as I just got there. So let's see. What do you think is the most important skill for a crypto CPA to have? I wouldn't say that there's necessarily one skill. It's going to be the combination of many skills, because you're really on the frontier of taxes and accounting when it comes to basically a whole new asset class. But I think just having a fundamental understanding of blockchain and digital assets, and definitely any specific digital asset or protocol that you're doing the accounting for, you need to have a deep understanding of. And combining that with the ability to read the blockchain and be able to track and trace transactions that are complex through various DeFi protocols and bridging across different blockchains. Just being able to, at a fundamental level, take a client that has a complex scenario and understand how their transactions are flowing on chain. And then the next step of that is a tax and a regulatory understanding to be able to, once you have this basic understanding of what's going on, be able to apply the correct parts of the tax regulations and apply the correct tax treatment to these transactions. So I think combining those two skills is probably, the most important thing for a crypto CPA, or for any crypto accountant or tax professional for that matter. And, I will say the regulatory environment last year and now moving into this year is moving at a very quick pace, and there's a lot to stay on top of. As a lot of you may see, if you're following my podcast or my newsletter, there's never a lack of new information, new news, new developments on the regulatory side that you constantly need to stay updated on and keep your clients updated on. And then someone just asked, what is a crypto CPA and what does a crypto CPA do? So a CPA is just a certified public accountant. So what I do as a crypto CPA is, I would say, two main things. We manage the accounting both on-chain and off-chain for digital asset investors and Web3 businesses. So helping them take their transactions that they've done throughout the year or throughout many years and consolidate those transactions, normalize them, and then categorize them and reconcile them appropriately for accounting and tax purposes. So, that's one of the main tasks or jobs of a crypto CPA. And then the other big one is helping out on the tax side. So once we do have accounting systems established, properly maintained and up to date, then, we can start to focus on the tax function, which is going to be preparing taxes and planning for taxes, basically. And that can be for both individuals and for companies. So those are the main tasks of the crypto CPA, although there can be many other things that a CPA does in the digital asset space. And I think the role that a CPA can play is going to continue to evolve as the industry matures as well. Let's see here. So this question is, what are the tax implications of using crypto assets to invest in non-crypto assets? So that's a good question. And to a certain degree, I would want to look at these all on a case by case basis. Like what is the digital asset you're investing in, what is the non-crypto asset that you're investing. But generally speaking, cryptocurrencies and most digital assets are going to be taxed as property. So that means anytime you exchange them for any piece of property, good, service, or you spend them with some sort of in some sort of exchange where you receive some form of value, it's going to be a taxable event. So if you do take crypto and use it to purchase something else, there can be taxable events associated with that. Of course, it does get specific to the investment structure and how you're going to have things structured on specifically on any given investment with the tax implications can be. But if you're going to spend crypto to purchase another asset, in most cases that's going to be a taxable event because you're disposing of the crypto. So let me see here. So this next question is basically getting into what is my opinion on the future of crypto taxation and where do I see things going for this current year and just for the future in general. And obviously that's a broad question, but I do think that there's a couple themes that have definitely taken shape, and I think that are going to continue into this year. And one of them is just this trend of a higher degree of information being collected for transactions that are taking place on exchanges and even on chain. And we see that with the proposed broker regs, we see that with Form 8300 and the 650I requirements. We're, I believe, going to see that with some other tax issues that can arise, such as the fact that DAOs are going to need entity structures to really get into compliance in many forms. So just general tax compliance, being able to be compliant with payroll and paying their employees, and just limiting the liability of their members. So they're going to need to form entities and have members that are responsible for tax functions. And also, I think sales taxes is going to become a huge issue in the future, which is going to require certain KYC information being collected for transactions where that's going to be applicable. So I think just something that the industry in general is not necessarily happy about, but there's going to be a broader level of information collection and KYC that's going to be required in many different forms. And that sort of seems to be the regulatory push to a very large degree, at least for the time being. Now, we'll see where this ends up and what the final regulations are, but the starting point for this is a very high degree of KYC. And once we start to consider the state tax implications, and then some of these ancillary compliance requirements with 650I and some of the implications with DAOs, I think there's going to be a lot of changes to happen in terms of a lot of the pseudonymity and anonymity currently in the space. And then I think another big trend that we've seen even indicated by the IRS is, a higher degree of just tax enforcement and audits, specifically with a tax focus. So even if you go on the IRS's website right now, they're estimating that there's only a 25% compliance rate. In other words, a 75% non-compliance rate. And this is based off of more or less information they've collected via John Doe audits, like we've seen recently in Kraken. They've been doing those for years and years, and other information sharing programs like the J5 agreement that they have internationally. So there's a lot of data that they've collected, and then they're basically comparing that with tools that they have to taxpayer reported data. And there's a huge discrepancy according to the IRS. I have already seen a big surge in new people reaching out to my firm who have gotten tax notices for previous years that they've been transacting in crypto and may or may not have accurately reported it, and now they're getting a tax notice and they need to address it. So that is sort of a trend that I think is getting indicated by the IRS, and that I'm seeing personally, is just that there's going to be a much higher degree of tax enforcement. 25% compliance picture, getting that up to 50 or 75% compliance. There's going to be a lot that we see just on this tax enforcement side. And I think that there can be multiple bottlenecks for people that are in this position that aren't reporting outside of just IRS tax enforcement. Another sort of related thing that I'm seeing recently is crypto is coming up a lot in divorce cases. I've recently, over the past couple months, have seen a fairly big increase in just people reaching out to my firm, just lawyers or people going through divorces, basically, where they want to do the accounting to get a handle on the overall assets in someone's portfolio, basically. So I think that even just outside of the tax notices, there can be these other bottlenecks that are related to someone's tax return, such as divorces, possibly in the future, mortgages, other considerations like this, to where there's going to be bottlenecks that are going to require people that aren't into compliance to start getting more into compliance. So I think those are some of the trends that I'm seeing. So this is a question that just got messaged to me. Is there a difference in how centralized assets are taxed versus decentralized assets? Basically, the short answer to that would be no, there's not. Basically, whether you're trading on a centralized exchange or in a non-custodial wallet, the tax implications to any given transaction aren't going to be different. It's going to depend on the overall nature of your transaction and the asset that you're transacting. And so the fact that you may be in a non-custodial wallet where there's not a centralized entity sending third-party reporting to the IRS really doesn't have an impact on whether or not you should report. So generally speaking, I would say no, there's not really a difference in how like a centralized asset versus a decentralized asset is taxed, if I'm understanding the question correctly. Okay, so then a follow-up question to this is, what are your thoughts on the potential of cryptocurrencies being used as a tax evasion tool? So I think, obviously, like I was just saying, there's not a high level of compliance, at least according to the IRS and other people. And there's this perception that crypto is a good way to evade taxes. That's something that you hear online. I believe it's the exact opposite, because when you're transacting on chain, you're on a public immutable ledger that many people believe to be anonymous, but really it's pseudonymous, meaning that all of the transactions are tied to a wallet address, and all that a taxing authority like the IRS or any other revenue agency has to do is basically tie your identity to that address. And that's where a lot of this data collection comes in that we see with the IRS, I believe. So So I don't believe that it's a good tool for tax evasion, just because your transactions are always going to be on a public ledger. So it's not the best place to really obfuscate your activity, even if you have some temporary pseudonymity, because that can get taken away basically at any moment. Especially if your non-custodial wallets are connected to centralized exchanges. So I don't believe it's a good tool, and I think people who maybe have sort of taken that approach in the past are going to start to learn the hard way here as we see more tax enforcement. Let's see here. So another question I had is, what are the tax implications to donating crypto? So in most cases, you're going to get a tax benefit for donating crypto. But there's one thing that I see that goes overlooked in this with a lot of people, and that is that if you donate over 5K or more of any property, including any cryptocurrency or digital asset, you need to get a qualified appraisal. And every tax year I'll have someone come to me that did a donation and did not get the qualified appraisal, and that is something that needs to be done to be able to get the tax deduction. And a lot of people are shocked when they hear that, because maybe they're donating Bitcoin and the price is sort of readily available publicly, but it just goes back to the classification of cryptocurrency as property, and that is just something that currently is required. So that would be the big thing that I would point out in terms of donating crypto is, if you do want to take advantage of the tax benefits and you're donating more than 5K, make sure that you are getting a qualified appraisal. Let me see here. So what are the tax implications of using crypto to pay for services? So anytime you use crypto to pay for more or less anything, if you're going to pay your CPA to do your taxes, or if you're going to go and buy $10 worth of gas for your car at the gas station, those are both going to be taxable effects, because you're exchanging crypto for a good or a service. So currently there's no de minimis exception that's in play, meaning there's no threshold to where if you spend a small enough amount it's not taxable. That's something that I would like to see, because I think that can help with just the overall of making it more easy for people to use crypto as a form of payment, because you're removing this administrative burden and this tax burden. But right now, if you're going to spend crypto, whether it's a small amount or a large amount, in most cases, this is going to be a taxable event. So yes, that means, if you have a credit card that's connected to a wallet that you have, or to an exchange, and you're out, making a lot of microtransactions and spending in crypto, those are all going to have to be accounted for and filed on your taxes, basically. So take that under consideration. Let's see here. So what is the most common crypto tax mistake that I see clients make? Well, if you're a longtime client of Camuso CPA, hopefully you're not making too many tax mistakes, I would say, because we're working with you closely. But definitely, when I'm working with a new client, there's usually some issues to unravel, and there's many different ones depending on the type of client, I would say. But one of the big ones is that, especially for individual investors, you need to make sure that you're saving your transaction information, especially, there's a lot of people where we're going back many years to do their accounting, because they've neglected it for years, and maybe now they're getting a tax notice. And what I see is they maybe were on some more obscure exchanges that may be now defunct, and they may not have all of their transaction data. So that is a huge issue, just saving your information. And I will add that even if you have all of your information, you're going to use a digital asset accounting software to help streamline your accounting process and improve your overall accuracy, obviously. But it's important that you save all of your data from these systems as well, and get a full consolidated history of your transactions, get a detailed ending cost basis report that's verified for accuracy with your due diligence at the tax lot level, get a full audit trail, full detailed gain loss report, income report, and save that for each tax year. I see many people that don't save this data, or for some reason don't get this data, and then they're left reworking it after time passes, and maybe they're trying to switch to a new CPA or switch to a new software. They don't have their detailed ending cost basis data. They don't have their full consolidated transaction history. That can become very problematic because there is a cumulative nature to accounting for your digital assets, meaning that unless you completely sell out of everything you own at the end of any given tax year, some of what you've calculated in any given tax year goes into your calculation for the next tax year in terms of your cumulative cost basis. So it's very, very important that you save all of that information, and you make sure that your data is not captive with any firm or any software or anything like that. Another huge issue is just taking incorrect tax positions. And we'll have to have a whole nother event to go over incorrect tax positions because they can take many forms. But just aggressive tax positions that are not disclosed properly, or just don't have a good just overall tax position, or basis and reasoning in the first place, that is extremely problematic. And a lot of times it can just come from a lack of understanding of either the specific asset or protocol, or the tax code, depending on who's taking the tax position. So I think those are some of the issues. Another big one is commingling, meaning people that will have a wallet or an exchange, and they will mix transactions together, meaning they'll take family and friends funds and they'll trade them on their exchange or their wallet. Or if you're starting a Web3 business, maybe you'll use your personal wallet for some of your business transactions. This creates an accounting mess because that's all going to have to be addressed appropriately, and there's going to be a manual element to that because there's going to be these personal and business transactions that are all mixed in, or just personal transactions with someone else's transactions. And if you do this on centralized exchanges, there's the potential for 1099 reporting that can have just further complications with the tax reporting and with your overall fact pattern. So I think commingling is another big issue. So I know we're coming up on the end here. So there's a lot more questions, and I really appreciate everyone messaging me with questions, commenting with questions, and I really also appreciate everyone that sent me in questions before the event to make sure that we had some good ones prepared. So I do have many more that I can get to here, but I really only had 30 minutes set aside, and it is sort of the kickoff on tax season. So I'm probably gonna want to jump off here shortly, but I do want to thank everybody for joining. And we do have another Q&A event. I'm calling this one an AMA, which I think is more consistent, which is going to be on March 7th. In between that, I'm also hosting a couple webinars. So we have tax traps to avoid in the Web3 world that will be on February 8th. So that is the next upcoming webinar. And then we have another AMA coming up in March. And in between that, you'll see that, I'll be popping up in some other events and just some other webinars and other things like that. So, keep an eye out on my page. There'll be a lot of other opportunities for us to, go over more of this information. And any follow-up questions that you have that I didn't get to, shoot me a message with them or comment below. And I'm going to list them down, and we'll do them on the next AMA. And these upcoming events, I'm going to comment them down here on this page so you guys can check those out and sign up for them if you're interested in them. And again, I appreciate everybody joining this event. I hope that you got some value from it. And until next time, I'm Patrick Camuso signing off.